Hey everybody, Mike DeSapley, Heritage Financial Advisory Group. Welcome to the Heritage Market Update for Thursday, November 17th, 2022. We hope you're all having a great week. We're back to update you on the markets and the economy. We're back on video this week, so we appreciate your patience. We had to deliver it via podcast last week due to some travel that our team had. But nonetheless, here we are. We're back. We have more to discuss, more to update you on, some more economic data that we had the chance to pour through. So let's get right to it. So just to recap the last 7 days, right, we had the election last week, which delivered us gridlock, and which is a very market-friendly outcome in terms of political outcomes. We had the CPI report last Thursday, a week ago today, which finally showed an acceleration to the downside, suggesting maybe peak inflation is behind us. We will see about that. And then Tuesday of this week, we had the producer price index, which shows the cost pressures on the supply chain from the producer side as opposed to the consumer, right? So CPI, consumer readout, PPI is the producer readout, and that also showed a decline. So we're starting to see some momentum build in the economic data, which has reinforced the idea that the Federal Reserve interest rate hikes are certainly taking hold. The market here had a great week last week, and it's working on another winning week here this week. Again, it's about Thursday, midday in the trade here, so we still have a bit of a ways to go to get to 4 p.m. Friday, but so far the market is behaving well coming off of the big surge that we saw last week. And by that I mean when you have a big move up like we saw at the end of last week, the first obstacle, if you will, or the first objective is to not give it all back within a couple days. And that's what this bear market had done to us many times, where we had big moves up followed by big moves down almost in succession. So this is setting up a little differently, but nonetheless, let's go through some of the economic data. Let's start with the market. Here is the S&P 500 over the last 9 months. So again, market is staging this rally here off of that potential October 13th capitulation low, right? That October 13th low was marked by a bad CPI number that the market rallied hard on. And then, of course, into last week, November's CPI for October's data continued moving this market higher. We've always talked about that a tell for a market that wants to bottom is a market that starts to go up on bad news, right? So a market that goes down on good news, that's not a good sign. A market that goes up on bad news would start to suggest that the market has fully discounted a variety of different fears and negative outcomes, and we've reached a point where these things appear to be priced in. Now, what we're looking at here is we have, apparently, it would feel that we have a date with this line, which is the 200-day moving average, right? So it smooths out the volatility in the market, and this is the point where rallies in the past have failed. In March, we reclaimed this space above the 200-day moving average, but couldn't hold, and the market got back below it. And then, of course, that rally in August into mid-August, we got right up into the 200-day moving average, momentum stalled, and lower the market went. Now, a lot of folks are looking at this and saying, well, we should probably batten down the hatches because the market appears it doesn't even want to test this level. It wants to reverse. But I think there's a little bit more to this. The market is certainly working through a little bit of a consolidation after a massive move higher last week. So we think we have a date with the 200-day moving average, which would coincide around 40.50. And if the market can get over and above it and through this 4,100 level, which is a very critical psychological level, which we failed at back in September, that would be an important development for the market. And it would suggest that maybe we can turn a lot of this overhead resistance into our new support levels and markets move higher. There is a bearish psychosis that's ingrained in these markets right now. Everybody is negative and bearish and thinks that, the market needs to fall another 30% before it could potentially bottom. And, we're not in that camp. I still think that the route from here is going to be choppy and volatile, but we believe that there are some conditions in place that would suggest the Federal Reserve has done a lot of the heavy lifting in terms of interest rate increases and tightening monetary policy, and they're starting to acknowledge that. As we look around corporate America, we're seeing layoffs en masse, and I think that's something that's going to give the Fed a little bit of pause. Now, we spoke about gridlock. Okay, the markets love gridlock. The data does support that. Now, why does the market love gridlock? Is because the market hates uncertainty. So now that we have two sides that don't agree on anything, the market can be certain that there will be no major legislative changes coming over the next 2 years. And if we look back at history and we look at Congress and we look at these different gridlock scenarios, we see that the S&P 500 performed very well most of the time. I think it was higher 80% of the time with an average gain of 20%. Average gain of 15% and the median being about 20%, right? So only three negative outcomes of all the particular, or previous, I should say, instances where we saw gridlock. A couple of the data points we want to go through. We talked about consumer price index starting to come back down. Well, that's a lagging indicator, but I think the evidence is there in a lot of other indicators that we follow a little more closely that feed into supply chain problems and inflation. So the first would be the Baltic Exchange Index, right? Dry shipping. This was one of the first places inflation showed up, where those transatlantic, transpacific ships, freighters bringing those big metal containers with all those goods back and forth. The cost of those skyrocketed early pandemic, which was a foretell inflation was coming, and it appears at this point we have a nice downward trend building there. So that's something that we like. When we look at truck transportation, we're seeing the same thing. Now this one bears watching because there's some diesel fuel issues that are brewing right now that could really reverse this trend. But again, we saw the peak for trucking and transportation costs in early 2022, and it's been moving down ever since, regardless of the type of vehicle that we're looking at. When we take it a step further, container freights, right? So this is similar to the Baltic Dry Ship Index, except this looks at different point-to-point shipping, right? Los Angeles to Shanghai, Shanghai to New York, New York to Shanghai, you name it, right? And we see that those costs are dropping precipitously right now as well. So we still are a little bit above the long-term average, but if this is a leading indicator on the way up, inflation was coming, it should be a leading indicator on the way down that disinflation is going to be the narrative that we're going to talk more about in 23. And last, of course, the stickiest component of inflation has been shelter, right? Housing. Now, we know that it tends to be sticky because real estate deals take some time to consummate. So, the deals that are being closed today were agreed upon a few months back and so on and so forth. But we're starting to see, when we look at the Zillow rent index, we're seeing that start to fall. And of course, we believe that that will lead to the shelter component of CPI starting to fall as well. So all these things bode well that CPI should start to come back down. So that was the first major hurdle that we needed to see. And now it's important that it continues lower, right? We don't want the CPI to go from 9 to 7 and then stay there. We need it to continue to show progress to come back down for the Federal Reserve to feel that their work is done. So all in all, the markets are still working through a little bit of consolidation. I think there is a pattern change here to observe, right? When you have down markets, or downward trending markets, we see tons of big down days followed by small up days, right? And those are the, kind of just feel like you constantly get knocked over the head. Every time the market tries to rally, it falls further. Up markets tend to be the reverse, right? Where you have big up days followed by small down days. And again, it's very premature here to call this a new bull market. It's very premature, to just wave the checkered flag and say that we've finished, the bear. But ultimately, we're starting to see that pattern change where we're seeing bigger up days and smaller down days in consolidation, right? So that bears watching. We'll see where we go from here. But of course, if you have any questions, reach out to us. We're always here to talk to you about anything that matters with your money. We hope you have a great day and a great rest of the week, and we'll see you back for the next Heritage Market Update. Take care.